Do you live in Dubai or the GCC and own shares in a US company? Perhaps they're an employee scheme. Do you know these assets can be subject to a huge tax bill when you die? No? Well, it's time to take a look at the US federal estate tax regime for non-US citizens and how to shield your assets against it. It's very common for investors who are not US citizens or green card holders to own shares in US companies, like those listed in the S&P 500, for example. There are also many US corporations operating in the Middle East who reward their employees with vested company shares as part of their remuneration package. Now, over time, these can have a significant increase in value, so it's important to be aware of the potential hazards posed by lesser-known US tax traps for non-US citizens, and this is a big one. Specifically, Chapter 11, Subchapter B of the US Internal Revenue Code. Now, that sounds interesting, doesn't it? Well, if you're one of the aforementioned shareholders, it may be time to take some serious action. The issue for non-US citizens or non-US domiciled persons arises upon their death. Not a subject many of us care to think about too much, but in this instance we certainly should. It's all to do with you owning what are known as US situs assets. Now, the word situs is defined as the place to which, for purposes of legal jurisdiction or taxation, a property belongs. And this covers all US company shares, even if they're held in non-US accounts, such as a custody platform in Europe or traded on exchanges not in the US. So what's all the fuss about? Well, if you're the owner of said US situs shares or assets, irrespective of the fact you may never have lived in the US, upon your death as a non-US citizen, those shares are liable to US estate or death taxes of 40%. Yes, there is an allowance, but it's only $60,000, and all values in excess of this figure are potentially exposed to the tax. So if you're one of the many people who have loved ones or other beneficiaries to whom you wish to leave your hard-earned assets, thankfully there are financial and estate planning tools we can use to ensure the IRS don't get their hands on 40% of your legacy after you've gone. We use effective and flexible arrangements to shield your assets from this tax and ensure your shares are protected. And what's more, there is no need to sell them, as we can simply relocate your shares using something called an in-specie transfer from your current broker or platform directly into a more beneficial holding vehicle. This will ensure your assets are ring-fenced and your beneficiaries receive 100% of their value whilst remaining under your control during your lifetime. Now, as a footnote, it's important to know that the US does have some estate tax treaties with a handful of countries, which may help to negate the death tax effect if you were born in one of those on the list. And they're noted in the description below. However, it very much depends on your individual situation, and I would encourage you to get in touch with us for a full financial planning review. My name is Macdonald. You can find my contact details below, so please do get in touch. Thank you for watching the video, and I'll see you in the next one.